Good Tuesday. Go. So I'm noticing a little bit of a pattern.
Whoa. Wait, hold on one second.
Sure.
It's not
Dale?
just me, right?
No, I think it's me too. Dale, you sound like you're in a fishbowl,
You
buddy.
sound like you're with Ryan, basically.
Yeah,
you
like
sound
you
like-
and Ryan hanging out this morning, or what's going on?
How do I sound?
It said that connection was unnoticed. They trained me.
Oh yeah,
Is it better?
No, that connection's horrible that you're on. Is there a
Why don't
way?
you take work on it?
Yeah, why don't?
Want me to
Yes.
do that?
Yeah, you need to restart your router or something.
Yeah.
All right.
Ryan, by the way, you sound good.
Oh, that's all right. It's a
Ryan,
catching
and
disease.
Ryan infected me. He infected me. All right. Anyway, let me see what I could do with this. All right.
All right.
All right.
Yeah, sounds
All right,
good.
guys.
We'll take over.
right.
Hey, good morning, guys. How are you?
Very
you.
well. Very well.
Good. We'll let Dale come in here in a moment. But you know what? I guess let's start off by saying what the hell happened overnight. I mean, yesterday in the chat rooms. And by the way, if you guys here, just kind of give you a little heads up. This is like our chat room from just this morning. You can see just from when I got up, you can see how busy it's been. And that's even before that. But last night I was in the chat room. I don't know where we'd have to go all the way back into yesterday. One of the things that I was saying yesterday is you got to be careful with equities. We're going to rally probably into the 618 retracement into the fib level. Oh, okay, here it's somewhere around here last night that I was saying, hey, you got to be careful that we're getting into that area where you might see equities find some resistance and you get a little bit of a reversal. And I didn't expect for the S&P to be down so much, but I guess it was off some comments from the Moderna CEO, right?
It was
Yes.
twofold. It was Powell started it last night.
Yeah, because Powell basically, well, yeah, I'll let you really talk about what he said, but really one of the things that he didn't say transitory, right?
Yeah, there was that, but he said about the virus, which is obviously the key thing at the moment. He said,
Who cares about the virus? You guys should move to Arizona. I'm telling you, you guys should move here. We don't care. No, go ahead. But jokes aside, go ahead.
He said there's a big risk, obviously, to employment from the virus and this new variant. And, coming from Powell, we've pretty much been waiting for all the central banks to come out and trot out the cautious line. So he started off, and that kicked yields lower in the US, and everyone else followed. We went through 150 in US 10s. And then on top of that, we got the Moderna interview in the FT, which probably cherry picked the worst of the comments out of the whole interview. I'd like to see the whole thing. And the rest of the morning, we've had ping pong headlines, Regeneron coming out and saying that they found that the effectiveness has waned on their antibody treatment. But then they say they haven't had any big tests, or there's no data to confirm tests on viruses, on the vaccines against the variant. Oxford Uni, who helped produce the AstraZeneca vaccine, they said there's no hard data yet to suggest that the vaccines are going to be less effective. So we've had these two big things from Powell and Moderna that gave everything the big kick lower. Then we've had conflicting headlines coming in this morning. European Public Health Authority also saying that so far it looks like the cases of Omicron has been mild in the EU, and the Netherlands has perhaps had it since the 19th of November, with no real major problems from that. So we're in that ping pong situation where one minute you get one headline that's negative, next minute it's not so negative, and the market is just moving in up and down based on that. And if the headlines are big, then we get these big moves. But what I'm looking at, and you've got up there now, is US 10s, and we've got a bit of a level here, 142, 143.
Right here.
Yeah,
Which you can see
important.
there then.
Hey guys, how do I sound now?
Hey Dale,
Better so far, yeah.
You sound much better, Dale.
you sound younger.
Okay.
Yeah.
Oh, great.
You sound like you're 35 years old. That's awesome.
Oh, man, I'm going to get in my car and pick up a chick.
You do.
Oh,
You
all right.
do sound a lot better, though.
All right. Thanks, guys. And one thing, I know it's serious what you're doing, but I want to thank Ziggy for doing that hard work on my genealogy, on my family. Blake, if you want to show my ancestor, Ziggy put it up on Twitter.
I must have missed it this morning because it was just in my stream. It was I see all this other stuff. Hold on, really.
Oh, okay.
Hold on.
Because
Oh,
it does run in the family, and I think
pull it
everyone
up
could
right here.
see the resemblance. Thank you, Ziggy.
Is that a pirate?
Is that Gandaldorf
Who
or
is it?
Dumbledore or Gandalf or who is that? Who is that?
It's Gandale.
Anyway,
Gandale.
Yeah, there you go. So
I'm thinking of Dumbledore because I just got finished with watching a whole Harry Potter.
actually, he kind of made me look like one of those rabbis from the old country. Shalom, Ziggy.
You actually do look like one of those rabbis. All right. Okay, that's nice.
Hey guys, one more thing I want to interject. Just one thing, and that's Friday, risk off, euro up. Yesterday, euro down, risk on. Today, risk off, euro up. I'm just saying, maybe we had it diagnosed before it really turns into something. I think it's a foreshadowing of how things will be.
Well, Dale, I'm gonna rebuttal that just a little bit, but something that we've always said is if the stock market sells off and you see a little bit of risk off, it's not dollar bullish. You have to be very selective on where you're selling or where you're buying dollars against.
Yeah,
it is definitely commodity currency and emerging market currency bearish should you see a reversal in risk. The euro, remember, is a funding currency. It is a carry trade funding currency. So unless the poop hits the fan, and I know I say this all the time, but unless we're down like 20%, at that point in time, we start getting down like 20%, you will see the dollar being bought against everything. The dollar becomes then the safe haven currency. But until then, it's going to be, you got to be very selective on where you're buying and selling dollars. But that's a great observation, Dale.
Yeah. Okay.
So, yeah.
All right. I'll let you guys carry on. Stella, are you buying silver yet?
Not yet, no. But I am looking at the euro. And for those who missed it, we got Eurozone Cpi today. And it came in year on year, 4.9%. Now the ECB are going to have to do something at some point or say something. So I'm starting to get a little bit more. I didn't think I would ever say it, but I think I'm getting a little bit bullish to euro.
I'm gonna short it.
Yeah. And the DXY, remember we've been talking about the 96.10 level, which was a 50% fib. These are not exact numbers, obviously, markets are never exact, but it did spend a lot of time around there. Now it's retreating. Equities are selling off, and that's helping the Dixie go lower. But I think we're getting to a point where we are pricing way too much in terms of the Fed. I've said this so many times, and way too little in terms of the ECB. And there's only so much that one major central bank can do before unless others follow. The Fed just can't go, tapering, hiking, and doing everything, and everybody else doing nothing, because then the currency is going to appreciate, and then that's going to hurt exports and everything that's associated with it. So I think we all know that governments want, in the back of their minds, they want the currency to be relatively weak because that helps economically. But I just don't think the Fed can go at it alone. I mean, I don't know if you guys agree or disagree, but I just don't see it happening.
Well, there is a difference between how the ECB and the Fed and others have approached the whole coronavirus issue. One of the reasons why the the Fed is a little bit more aggressive is our inflationary pressures here in the U.S. seem to be more aggressive here than they are in other places. Now, I know we just had some Eurozone CPI data come out, and I think you're right that the other central banks have to act to a certain extent, but the majority, I think that the real pressures that you're going to see, inflationary pressures, are mostly in the U.S., right? I mean, I don't know.
Well, inflation in the U.S. is what 5.5% or whatever it was, and now it's 4.9 in the EU. So it's same order of magnitude, And its problem is it's rising, and it's rising everywhere. In the UK, the same. Actually, yeah. Japan is the only major economy where inflation is still very low, but they had zero inflation for 3 decades now.
Right. Hey, but those are great points, and here's the thing. I really believe that the euro is heading back, and I know I've said this a lot over the last 2 weeks. I think the euro is heading back towards the 115 level, but you got to be able to sell it up there. And I think this is a great, example of, the market got very bearish, the euro, when it was, breaking lower. And, as we pointed out in the last 2 weeks, week ahead video, when we were trading here at 112 and change, it looks like we're going to, be bouncing back. And I think you gotta be ready to be a seller up at the 115 level. And I'm just hoping that we get to see it. And I think we will get to see it, but I think you have to be willing to step in front of it here. And for those that aren't, you have to realize that this is the overall trend in the euro is lower, but we are seeing some pretty good reversals the last week and a half here. So now Dale, Ryan, or earlier before Dale jumped in, and we got to hear
interrupted you.
No, he just make sure his microphone was working. But Ryan, you were talking about the 10-year approaching this really key support here. So what are your thoughts here with the 10-year?
Yeah, I hope my mic's okay, because you're coming a bit craggy.
Me?
I don't know.
No, he was perfect.
Yeah, I think I hear you coming in a little bubbly again. So, but anyway, go ahead.
Yeah, no, just saying we're into zone 137, 138 is just under this 142 area. That's another zone. You can see those highs through August, September, October. That's if we break through this 142, 143, that's the next level to look at. But that should give us another kick lower in risk. But it's holding at the moment. I'm twofold on the euro. I think on the longer term, we spoke about, once the Fed is all settled, we know the high path, the euro is going to be a buy. I think this move now on the virus stuff is potentially a sell if we get up to that 115 area. And then if this virus stuff passes, we should see the euro, come back down to 112. And then we move into the Fed part and perhaps look for longs after that. So, yeah, I'm in the same boat at the moment.
Okay, well, for those of you guys that are like, I'm going to point out a couple of things regarding the S&P, and I'm going to talk in generality. Shit, you guys know what I'm saying. I'm going to talk about the S&P, but speak in general about the equity markets. I know everybody will say, and everybody's going to tell you, and I'll be the first one to tell you, that stocks are overbought at these levels. I think they're overbought. I think that, we are going to correct, but I don't necessarily think that right now is the time that we correct. I actually believe that we're going to have a very tough year next year. I think 2022 is going to be a tough year, but don't forget, we have end of month flows coming in today. We're coming into December. This is a very, seasonally, this is not a bad time to be long stocks. And let's not forget that we are holding above 4550 in the S&P. So I guess the point I'm trying to make here is, I think that stocks are overbought. For me to be buying equities right now and close my eyes and say, okay, 3 months from now, I want to open my eyes and see where the stock market's at, because I think I'm going to make money. I don't think this is the right time to be positioning yourself fresh with new longs. But from a trading perspective, I'm not sure that risk has a lot of downside. You got a lot of these, comments that may have been taken out of context yesterday by the market from the Moderna CEO. And as Ryan pointed out, I think I'm going to go back and try to listen to the entire interview. But from the notes that I've read this morning, just from a few people that had listened to it in Europe, they said that they kind of the media cherry picked, like the journalists cherry picked a lot of the words that we're hearing, right? So, you got to be careful about chasing markets lower while we're above 45.50 in the S&P. Now, there's a couple things that have really stuck out today. There's a couple things that really stuck out today that I think we need to realize before you start selling stocks and selling risk. Okay. One of them is the dollar Mexican peso. Now, I was long dollar Mex the last 2 weeks. This pretty much made my November. Between this and the Rand, I was long the dollar. If you guys are in the ForexAnalytix community, I was long this dollar Mex. I was long, the dollar Rand, which has been my chart of the day for our just like been my focus really for the last like 2 weeks, right? So here's the thing. The dollar Mexican peso hit 127% extension of this last move right here. We just started breaking back down, and this is a 261% extension of this last leg lower, 261% extension here. We are back below the breakout point today. So what is that telling me? Well, that tells me that you've got to be really careful short risk when emerging market currencies start moving higher. So let me say that slowly. When emerging market currencies start strengthening, you have to be careful shorting risk. Okay. These emerging market currencies have been weak literally for the last couple of weeks, suggesting that the S&P might be peaking. But now that they're starting to show strength again, that means that the market, generally speaking, is willing to take on risk of owning emerging market currencies. Now, it'd be one thing if you're just looking at the Mexican peso, or if you're looking at other emerging market currencies too. And when you start to see them pop in around other emerging market currencies, you got to be careful. Now, also, that goes the same with commodity currencies. If you guys did not see it, the Aussie dollar hit a brand new fresh low today and is near the highs of the session right now. Kiwi dollar, same. Fresh low below the breakout point, by the way. This is my chart of the day yesterday. Below the breakout point here, below the breakout point here from way back in 2019. And we are near our, not too far off, our highs of the session right now. Dollar Canadian hit a fresh high above 128. Brand new fresh high above 128. Key resistance, what could be, I think, is a triangle forming, but key resistance, and we got a reversal. So just be careful. And Dom points out, and the CNH is strong too. And yeah, that's another great point, which I wasn't even looking at this morning, by the way, Dom. Thank you very much. So if you're out there shorting the S&P, selling risk, be careful. You got the Kiwi hitting highs, you got the Aussie near highs, you got the Mexican peso at highs of the session, dollar Mex at the low or at the lows. I would be really, really careful chasing risk lower. Now, I'm not saying that stocks won't go down. I think they're eventually going to go down. And I think that, like I said, I think 2022 is going to be a really tough year for the market. I think it's going to be a really tough year for the market. And actually, I believe the next, 5 to 10 to, more years is going to be very tough. I think whatever's happened the last 12 years is robbing our children and grandchildren of the next 20 to 30 years in equities. That's just my personal view. Meaning that
it's okay. They have NFTs.
Yeah. I mean, why not? I mean, hey, by the way, I gotta point this out. Stelios was in the chat room earlier today. This is again, for those of you that are not.
Yeah, that was ridiculous.
This is crazy. Oops. I didn't mean to do that.
This thing tells me, it describes everything that's wrong with markets and the perception of risk nowadays.
A mega yacht in the metaverse. Now, everybody understands the metaverse is not real, right? I mean, I know it's nice if you're playing Roblox, the video game, and you have Nike Air Jordans on your little block person that people see. I know that's really cool and everything, but it ain't the real world. You're not actually wearing Air Jordans on your feet. Like, you're wearing them on your Roblox feet or your Minecraft feet, but if I unplug the computer, your feet are gone. So, this whole imaginary shit, sorry, excuse my language. This stuff is really, really bothersome to me because I just don't get it. And I'm not saying it as a boomer. I'm just saying you poop, you eat, you sleep, what's the word I should use? We do the dirty in real life.
I get it. Okay, somebody bought it in hope to sell it at a higher price. If that person says so, I think they're very clever. But if anybody claims anything else, I think my personal opinion, there's they have to look at that problem of theirs. But anyway, I just don't get it. I think, as a speculation vehicle, yes, of course. But anything else, I don't see it. I really don't.
Yeah. So anyway, that's that pretty much speaks volumes about where we're at in the market. And look, I'm going to go back to a conversation that I've had, on many occasions with our ForexAnalytix subscribers, just like with our private webinars that we do. If you guys are part of the ForexAnalytix community, you get access to like all of the webinars we do throughout the course of the day. I have the daily roundup and morning edge where I can speak a little bit more freely and more openly and, kind of rant a little bit. And I want to say this about, where we're at with the metaverse. I don't disregard the metaverse. I actually think the metaverse, there's value there. That's where a lot of young people are going to find value in a lot of things. That's where the future is to a certain extent. It's kind of like the internet. If you think back in, 2000, 2001, 1999, it's like, all these aspirations. I know I've said this maybe to you guys before. I can't remember exactly where. Back in 1998, I invested $50,000 into an internet telephony company here in Phoenix, Arizona. If you don't know what internet telephony is, it's basically Skype. I bought into a company that basically did what Skype did. I guess, what was it, 4 years ago, somewhere around there. I've got the stock certificate in my office here. If you really want to see it, when I bought that stock, I was like, wow, I'm paying $50,000 for this company that just has this technology that is going to revolutionize the internet. And that technology, well, Skype is one of the many things that have really evolved out of, the internet. We communicate freely. I mean, I pick up I jump on Skype and I can call Steve or Stelios or Ryan, any one of our team members anywhere in the world and talk to them, immediately. But that company did not survive. And that company went away. And that company, blew through all the money that they had raised and it was gone. But the technology was here to stay, and that eventually became something. And I think that we're going to see a lot of that with these cryptos. So I'm going to say that the metaverse is probably, I would say in some way, shape, or form is the future. And what you see with, there's going to be value, and you can see it with kids today. Like my kids don't really play video games like they did, a few years ago. But when they're, my son is on Minecraft. One of my kids, well, actually both my kids were on Minecraft. They could create things and then actually sell them for real dollars, like it in a marketplace. Like that will happen, and people will find value in that stuff. $650,000 for a virtual yacht that you can't poop on, pee on, look at, do the dirty on, which if you have a yacht, the only thing you want to do is do the dirty on the yacht. So why do you have a yacht? Oh, and I guess to travel on, to get to one place to another. I mean, I don't see it. And I get what you're saying, Stelios. It is purely from a speculation standpoint. And I can't believe it's like passing a hot potato and getting
or Jane, as Jane correctly said, it's also money laundering, right? We can't get away from that.
These are the type of assets that immediately go to zero the moment you are in a recession or depression, because there is zero bid for them immediately.
Yeah, I mean, I don't think anybody here is going to be buying a mega yacht, Steve, and I agree with you. But the thing I think that we have to just recognize that yeah, I mean, this is a very speculative environment, and that's why I do believe that the next 5 to 10 years are going to be really tough. From like if you buy, I think stocks, I'm not going to sit here and say, oh well, the S&P is worth only a quarter of what it's valued at right now. We should sell S&Ps, and we're going down to 1,500. I'm not going to sit here and say that. I believe there's value in the real economy and in stocks. Do I think that stocks might be a little overvalued here? Sure. Can we correct from here? Yeah, I do think so. But what that's going to set up, in my opinion, is we're going to have a good 5 to 10 years, maybe even longer, of a consolidation of risky assets, or we can call it just risk assets, where you're going to see, this explosion that we've seen higher in equities, probably subside. And, we're going to probably be, this is a monthly chart of the S&P. We're going to probably be sideways for a long time. And like I said, it's going to rob the future of,
depends on what happens
Steve,
with inflation.
Hold on, Steve, I was just going to finish off what I think is going to rob like the future investments from our kids and grandkids. Go ahead, Steve.
Depends on what happens with inflation. Because if inflation keeps being rampant, then in nominal values, there is no reason for stocks to stop moving higher. In real values, yes, they will. In nominal values, they have to adjust for inflation.
By the way, guys, we have Canadian GDP in 2 minutes.
Yep. So we'll jump into the Canadian data. Thank you guys for your input there. And one thing I just really want to, again, I really want to point this out. Not regarding the Canadian, but just regarding what you're seeing today. I just talked a lot about like the metaverse and what you're seeing here. We go into a lot of deep dive conversations and kind of, just chatting about things in the ForexAnalytix community. We, just kind of talk and, there's more, conversations and taking into account what your comments are. But I just want to say for today, I do think that you have to be careful shorting the S&P here. And I'm not saying that because I'm bullish stocks. I'm just saying that because, I think maybe intraday, some of the stuff may have been overblown. That's
good because I've gone long.
Yeah. Did you?
Yeah. 06. A few of us went long in the room.
Yeah. And I don't think that's, I don't think while you're above yesterday's lows, I don't think that's like, hey, look, you're coming in the US session. This is where us Americans, we just buy everything. So, you get in the North American session, we just get long, right? So what happened yesterday probably is going to happen today after, people are going to say, oh, that's just, that's over exaggerated move overnight. But look, I think overall we're just going to have, issues with equities in general. So let's
NASDAQ holding up much better than S&Ps for some reason, must be lower yields.
Well, that's it, right? Because if yields go higher, they're going to pound the higher beta names. I mean, one of the things about the NASDAQ is that we had, and by the way, let's get this data out here. we had just the big names really rallying yesterday. So just keep that in mind. It's really the usual suspects. You're not going to, oops, I just clicked the wrong thing here.
Tesla was up 5%.
That is not what I wanted. Okay, here. Okay, so watch Canadian GDP.
Where is it?
Where is it? And we'll actually look for the Canadian response here. Let's go over to a.
Probably stuck in snow.
If you've ever been to Edmonton, oh my gosh, that is like the coldest place I've ever been in my life, and which probably isn't saying a lot for a lot of you people. You know, I say that because I live in Arizona. I'm a wuss when it comes to the weather. What?
5.4%.
Oh, why isn't GDP coming out? Or
quarter on quarter annualized.
Wow, that did come in a little lower than expected. Revisions were revisions too. Yeek. All right. Well, got to be careful with this Canadian dollar chasing it up here after such a big move higher. I look at the Canadian just longer term. That looks like a triangle consolidation to me. And I'm not saying that we can't go back and revisit these levels from, you know, this is the previous spike highs up here from 2020. You know, we talked a lot about it when we first revisited that in August, but you can see what key resistance. Now we're starting to push in a consolidation. So, you know, if stocks hold a bid, then the dollar Canadian will probably, you know, get back below 127 again. And, you know, before we figure out what we're going to do next. So anyway, guys, thanks for jumping in here today. It's nice having you all here. And thanks for your comments. Stelios, Steve, Brian, Dale, get out of the bubble. Hopefully you can get out of the bubble for your interview with Dana. And I want to thank you all for being with us today, and good luck today.
Cheers, guys.
Have a good one, team.
Cheers, everybody.
Cheers, Stel, Ryan, Blake, Steve, Volgi, and welcome back to F.A.C.E. Dana, how are you?
I'm good. Thanks for having me back, Dale.
Oh, good.
You got me?
Yeah, got you. Nice to hear your
Gotcha.
voice. And I believe you want to share your screen today,
Share
Dana?
screen. Gotcha. Yeah.
Okay. So,
Perfect.
what do you make out of the last 3-4 days action? I know you're macro, Dana, and you know, it's going to take more than this type of, you know, 1 day bear raid on the market, and it came back, and NASDAQ holding up a little better than S&Ps. Anything changing in your work, cracks in the armor of the bull market?
You know, we operate mostly in what we call the intermediate term time frame. So moves that are
Okay.
on the order of like 2 to 6 months. So we had, you know, after, if we scroll back a little bit,
Yeah.
following the election last November, which was a great setup. It was one of the best buying opportunities in years. We saw a nice consolidation. We saw a nice uptick in fear leading to up to that election, which I think was unwarranted. People were concerned about, at least pundits, whoever those are, were concerned about, you know, chaos after the election.
Yeah.
We thought it was, from all of our analytics said it was lining up to be a great buying opportunity. We saw that historic post-election rally. So this is the value line geometric composite, which tracks the median stock in the market. So we saw a historic run up into the spring. We've seen since then, we saw pretty much a 6-month consolidation. And for us, it looked like, you know, entering October that from an internal and a technical standpoint, we were setting up for perhaps after that consolidation, a nice, the next up leg in the rally.
Yeah. So what do you make out of the market after taking 6-8 months to create enough energy for a breakout for it to be trading substantially underneath it here?
Exactly. And I think that was the right read of it. You know, we pretty much just worked off those excesses. gathered fuel again enough for the next up leg. And but a funny thing happened along the way. So we have a quantitative model that quantifies the risk in the market, and most of it was bullish. We had one holdout among the indicators related to breadth, and it's one indicator that has often kept us on the right side of the market, even when other indicators go the other way. And it refused to budge to the bullish side, and has kept us hedged to some degree in during the pullback in November. And I often think about various lessons to be learned, and even after many decades in this market, I'm still learning lessons. And one lesson is always that these quantitative models that we build them for a reason, because they're smarter than we are. Even decades in managing money, we're still subject to human nature. We're subject to, as humans, surface level analysis, whereas a computer can instantly dive many.
So where were we getting some cautionary signals from?
Yeah, we had one of our key indicators, breadth indicators, did not go bullish. It's kept our model on the bearish side. I think it does eventually split bullish, and we do get that next up leg. But it gave us an indication that all was not, ready for that next up leg. And we did obviously saw that pullback in November, which looked like for all the world to be a buying opportunity. And you flip to the Russell 2000, looked like after that consolidation, we had that breakout, maybe the most transparent and high profile breakout in recent memory. And we saw the rug pulled out from under it, and especially last Friday saw an acceleration of that. So
what makes you think it's going to flip back to bullish here, Dana?
I think underneath the internals, which a lot of our quantitative model is comprised of breadth components, internal components, and I think the foundation is solid still. On a technical basis, I think the foundation is solid still. The small caps, that value line, and the Russell 2000 is on thin ice right here from a technical basis, so we could see some more short-term acceleration downside if we do see a break here. But for the most part, you look at most of the averages, most of the indices, everything is in pretty good shape. I think what happened, which often these days is the best short-term, perhaps the best short-term guide for trading, is sentiment got too complacent again. It bought into that October. We went right back to excessive bullishness, and that had to get reset. And finally, we're seeing a bit of a reset of that. If you look at Friday's action, we saw here, this is the term structure of the volatility market. So we saw the 1 month to the 3 month volatility market get up close to that one level. So if we see the 1 month above the 3 month, then we're seeing like a pretty good indication of investor fear. So that we're approaching the highest levels since the election last year, which is a good sign. I like to see it even higher, maybe up towards that 1.1 level, to get an indication of reliable bottoming type of sentiment, type of fear level. So at least Friday brought us along the way towards those type of sentiment readings. But that's been one of the holdouts. Even in that pullback in October, we didn't see a real spike in investor fear. We've seen a lot of complacency, a rampant buy the dip mentality. So we need to see a little bit more of a shakeout, I think, in investor sentiment to set that, that real good tradable bottom.
Okay. Any line in the sand, Dana, for when this turns out not to be a correction, but only know in the rearview mirror. But it's probably not a price point. You'll need a lot of your indicators to flip, not just one, for you to have a belief that there's problems.
Correct,
Yeah.
and that's another lesson I've been thinking about lately. Is and you know this, years ago or decades ago, I should say. The market changes. It's constantly changing on a micro level, on a macro level, in the long term, and in the psychology. The markets will never change. They're always driven by human nature. But on micro level, they're always changing. For example, go back to that Russell 2000 breakout again. You know this, decades ago, you get a breakout to all-time highs. That's guaranteed money. You jump in on that,
Yeah.
and it runs and runs. Now it's more the rule than the exception that's a failure. We see a short-term fake out.
Breakout failures everywhere.
Fake out to the upside or to the downside.
Yeah.
It's the rule more than the exception, especially in an instrument, an index that's more widely followed, like the S&P or the Russell 2000. The more eyeballs are on it, the more subject it is to false moves. So that's what we saw in the Russell. So that is right now would be one short-term line in the sand, but the market itself is much bigger than.
Is that what we got, Dana? I thought I could ask you this one. In the gold, where 2 weeks ago looked like a breakout out of a triangle, and then we negated the breakout a week later. There was
I did.
Do you know what I'm saying?
Yes, exactly. From a short-term perspective, we saw that. We trade ETF, so here's GLD.
Right.
Saw that breakout. Made a nice local higher high. From our perspective, we're still in this longer-term consolidation, though. So, from our perspective, it's a trading vehicle right now, and we saw that rug get pulled out from underneath the investors too, right there.
Right.
So GLD, SLV are on thin ice right here from a short-term perspective, as well as if you look at the miners, we trade again. The ETF. So you look at GDX or SLV, for example. I should say GDX or SIL. Gold miners, silver miners, also on thin ice right now. But you can see, it moved above the 200-day average. Big deal. We're still in this consolidation here. We're in this mess. So it's a trading vehicle. Buy the dips, sell the rips. And right now, we're on potential support here. So we took some profits a couple weeks ago, bought some back the other day. So, but in the grand scheme of things, I think it's still consolidating here. So I don't think you want to take big bets either way. But now that we're on gold, you're going back to GLD. I think like many assets right now, it's in the in general, it's in the buy the dip category still. I think from our longer term perspective, basically what we saw was GLD and gold back in last year rallied back up to the highs from 2011, 2012, consolidating that rally right now. So after we rallied for about 4 or 5 years, not unusual to see this consolidation. Might be forming some sort of a big cup and handle. So this is one reason I think eventually we do see another up leg here to gold, and same thing with.
Wouldn't it help, Dana? Dana, wouldn't it help the case for gold? And gold actually did rally for a while with the dollar being strong. Are we getting, when you look at the dollar now from the COVID highs to last year's low when everyone came in bearish dollar last year, wrong-footed, that now we're getting into a retracement level where it's going to be an important battleground as to whether this is a bear market rally correcting that decline from the COVID high, and that the dollar could end up rolling over and failing from here, maybe at 98.
I think it's very possible. There's the dollar index, again, everyone wants to be bullish or bearish, like
the opposite of a year ago.
Yeah, I mean, sometimes you're just in a trading market, like we've been in equities, like we talked about for the last 6-7 months, in gold and the dollar. We've been in a trading market for years now. So here's the dollar. To your point,
Yeah.
we've basically just retraced 50 to 61% of that drop, that decline from the COVID highs. And interestingly enough, sometimes I leave these trend lines on my chart. I don't look at them for years, but lo and behold, where we stopped the other day, we saw that the underside of that uptrend line since 2011 that was broken last year came right up and hit right at, I haven't even looked at this trend line in, in years.
Yeah.
Hit the underside of that, and the pullback. We also have, that 61 retracement approaching up around that 97, 75 level or whatever.
That's what I'm looking for.
Yeah, pulling back right now. Probably a good support level would be around 94 to 94 and a half right now in the near term. So, but
when
again,
you think
still
about
in a trading range here.
Yeah, and you know what? When you think about it, the behavior, a lot of people thought if you would have said at the beginning of last year that the dollar is going to rally 10, 15% this year, you would have thought that it would have been a headwind for risk, that, that dollar is being bid because of risk, and the market did just fine with a recovering dollar.
Right. Well, and again, it's one of another lesson that I learned years ago in this market, jumping into this industry, is relationships are always changing. You can't rely on
correlations. You mean?
Yeah, correlations, intermarket analysis. My thought is, it's hard enough to figure out which way one asset is moving. Much less trying to figure out which way an asset is moving because of which way another asset is moving. Just to figure out, put your analysis, put your efforts into figuring out each chart, each asset on its own merits. Don't worry about the correlations.
That's a pearl.
Because they're always changing. Because you look at, all right, since 2016, stocks have been pretty good, right? Since the election. Here's the dollar since 2016. Find the correlation there. There isn't one that's going to help you out, right? So, figure out, what those inputs are that are truly important to whatever market you're trading, and don't worry about the relationships. Some people, certainly there are investors that have systems that have methodologies that are based on that they're effective with. That's not something that's that important to us.
Okay. All right. Yeah. So talking about something that's recently corrected, this pullback in energy, crude 85 to about 68 today or so. What are you thinking? Just another buying opportunity there too?
That's another asset that I think is, after a nice rally, still in an intermediate term uptrend. So this is the GSCI crude oil index, which we track because there's no, rollovers or anything like that. So still in an uptrend, higher highs, higher lows. I think most of the inflation trade is still a buy the dip mentality, but again, it's not an own at all levels. You got to take some profits. You got to take some risk off the table at time, and certainly Friday's plunge, like with the equity market, I think it was a kind of a shock event, and this when you get those short-term shock events, it's going to take a short-term process before you put in the ultimate low and can put in a tradable low that you can rely on. So we're going to have some ups and downs in the short term. We're going to have some testing again lower before we get that the reliable, that substantial low that you can really trade against.
Yeah, that's another pearl. It's almost like being in a car wreck. The market's in shock, trying to stabilize, and the only thing that stabilizes the market is time.
Right.
So you have to give it some time to.
That's right. And one, unfortunately, one aspect of yesterday's market was that after, I looked at the term structure volatility, people were So quick to jump back on the bullish bandwagon yesterday.
Yeah.
We saw
Yeah.
a drop in the hedging instruments, a drop in fear, and people, especially in the options market, people are right back in buying the call options, dropping the hedges. So that was disturbing to see, and probably an indication that we've got certainly more testing, at least on the downside, which we're seeing here in the pre-market futures, and more of, especially given the breadth yesterday. The Russell was down, breadth on the NASDAQ was down. How could you be that confident in that in the rally yesterday? So another indication we got more testing ahead, at least in the short term.
Okay, so we're entering this period of consolidation before another wave to the upside. There's no number that you would say, this market's in trouble. Say, like, if we close under 4,500.
Again, going back to another lesson. People ask me about levels on the S&P 500.
Yeah.
If you look at the S&P, it hasn't done much over the last month. But if you look under the surface, you look at the different sectors, you've seen energy stocks getting smashed. You were talking about technology before I came on, has been holding up very well. Financials dipping of late. There's a lot of action under the surface. So the action, the quote unquote market is a lot more than just the S&P 500.
The rotation.
Yeah. And if I could come up with levels down around 45, 65 might be a decent level. We've got that's the 38 retracement from the.
Where does your 1.618 come in at new highs above that? Top of your chart.
You talking about from the recent little pullback up 48, 40, I guess. But if you look at, that's a good point. That 161 extension from that little September pullback, we stopped right there on the S&P 500, right? So again, that's another indication we're not quite ready to for this thing to blast off. We're not hitting escape velocity yet. If you look at the NASDAQ 100, same thing, 161 extension. We stopped right there. We had that false break above there last week. And the same thing, I believe, in the Dow. So right now, it's still a bit of a trading market. You've still got to manage risk here in the short term, but eventually, I guess this one's a little bit short, but I think we are building up to another pretty good intermediate term low, and probably a new up leg in the bull market before, I think, long story short, I think we see a decent higher high before the rug gets pulled out of this from this bull market.
So will Santa be bringing that rally to the market, or do we wait for
I hope
the
so.
January effect?
No, I think, and the January effect starts before January, and the Santa rally is really towards the end of the year. I think we bottom before that. I think, like I said, Friday's impact on investor sentiment was constructive.
Marginal.
What's that?
It was marginal. They came in buying the next day. It was like
yes. Yeah. They've not learned their lessons yet. But Friday was a good first step towards that. On a technical basis, we are. I showed the Russell 2000 earlier, and the value line on a critical level right here in the short term, around 2240 on the Russell. We break this. We might be down closer to that 2110 level pretty quickly. But again, like we talked about, breakouts and breakdowns, especially on these widely watched indices like the S&P 500, the Russell 2000. Everyone knows this. So on the short-term basis, it could cause an acceleration to the downside. But guess who's watching this? Goldman Sachs is watching this. They've got, just like they were on that breakout, earlier about a month ago, everyone was watching that. They took advantage of that. they're going to run
Yeah.
the stops here and make a killing on this false breakdown when we do have it. And we'll get, the good thing is we'll generate enough investor fear, enough panic to eventually put in that tradable low and probably kick off a decent rally. So hopefully Friday was a start to, build up that investor skepticism. But we need some more on that process.
Any of the credit spreads bothering you, Dana? HYG under pretty good pressure last few months.
Yes,
And
well, that was
LQD under pressure the last few months.
Well, there's always something to worry about, and in that October rally, let me see if I can find my HYG in that October rally. One thing that we had to worry about was that holdout on our risk model that never turned bullish. Most everything else looked good. The one thing that did not look good was high yield, right? So here's HYG in October when risk assets were rallying. This thing was going straight down. So that was another red flag, another hiccup right there. That indication that all was not in place for that rally. But so we've seen lower lows there in high yield. We did see a nice rally there yesterday. So we'll see if we do get another lower low here in the short term in equities. We'll see if the high yield, the junk bonds can hold above their low that we saw Friday, which would be the start of at least something to start hanging your hat on in terms of the credit market.
I mean, isn't the bubble of all bubbles still debt? And and that if we start having problems, this is where you look for them first.
Yeah, I mean that's what they say. Credit's always
does that saying still hold true? Hey, Dana, let me ask you something. Does anything I've learned over the last 30, 40 years still mean anything?
Well, your experience means a lot, but as like I said, on a macro basis, the market will never change, right? It's always going to be driven by investor psychology, and human nature is never going to change, which means people like you and I will always have a job, right? Taking the other side of that. But on a micro basis, things change in terms of how the market trades, and you have to change along with it. Like I said, breakouts are not, guaranteed money anymore. In fact, you have to learn how to trade that. More often than not, you'll get that pullback to at least test the breakout level or test the launch level before we really get going. So you always, you pick up that long-term wisdom and experience, but you're always relearning, always picking up new things on a micro level, right?
Yeah. How many NFTs have you acquired lately?
Oh, I'm not even gonna waste my time trying to understand that, Mark.
All right.
I've got enough things to deal with.
How many duty coins have you accumulated?
Cryptos, if you had asked me 4-5 years ago, I'm like, I'm not gonna even bother with it. But someone asked me about it, like Bitcoin, back in I think it was 2014. I'm like, well, I'll look at the chart, and I'm like, I was astounded that it basically, as much as anything, conforms to traditional charting analysis. So I'm like, well, if we can reliably trade these things, why wouldn't we? So we do. We are trading cryptos, Bitcoin and Ethereum. Much to my surprise, if you would ask me 5 years ago. But again, they're pretty reliable trading instruments on a technical basis. So that's another market that I think they're by the dips, right? For the most part here, still in a long-term uptrend. So you got to manage them on a short-term basis, especially how volatile they are. But
very. You're a gunslinger like you used 20 years ago. Well, anyway, buddy.
Yes.
For people to follow you, And if you want to show site and your offerings and how they could get involved with you, as I think Dana's great. And it's great. He's a veteran that learned how to become millennial.
Yeah. So our main business obviously is our money.
Oh, Black Friday! Oh my God!
Right. I do have this new trading website or subscription site that I developed about 5 years ago. Once I thought I'm going to scrap all the social media because it doesn't do anything. But then I thought, well, a lot of people are asking me to keep going, so I expanded it on a subscription site basis. So the lion's share is basically I tell you what we're doing in our management business, and you do it yourself every day. So we do have our biggest sale of the year is going on right now, which I extended one more day today for your listeners because it was supposed to end yesterday. So if you're interested, go to the Lion's Share Pro or lionsharepro.com and you can check it out. Other than that, like I said, J Lions Fund Management is our managed assets business. We have another service for 401k investors, my 401k Pro, but this is all the information for me. You can find me here on Twitter, StockTwits, all that junk. So
trade with the heart, trade with the heart of the lion, Dana Lyons.
There you go. I love it.
All right. And, thank you so much, Dana, for coming here and still, so you're still sanguine. What about 2022? Will some roosters home to roost? I know you're not a forecaster, but it's just a vibe I have. How are you?
Yeah, you would think so, but the way that this thing has kept going over the last dozen years, it's hard to pinpoint that. Eventually, there's going to be the mother of all, reckonings. When that is, I don't care about it right now. I'm just going to keep riding the flow, and eventually that's going to be.
You don't have to worry about it because you'll know your work will tell you.
Follow the data, the market data. It always tells you.
Yeah, he was a great character on Star Trek. So follow data wherever he goes. Do the right thing today, and tomorrow will take care of itself. Thank you.
All right, always a pleasure. Thanks for having me on, Dale.
All right, Dana Lyon. You can follow him at Lions Management, and Dana, aggressive trading year, and we'll set up a term visit for you. So
sounds great.
Thanks. Hey, thank you, buddy. So wrap. Remember, everyone, to count your forecast, count blessings. I'm glad everyone saw what my ancestors looked like, Nostradamus or Rabbi. And Gorkum, Laura, John, thank you guys. And hunting the rest of the day. Be back tomorrow. The team in 13 minutes for the morning edge, and you shave before you. That's guys. Adios.